This is Wall Street Examiner Fast Facts on the web at wallstreetexaminer.com. It is June 11, 2014. I'm Lee Adler. Janet Yellen's favorite indicator, the Job Openings and Labor Turnover Survey, or Jolts, jolted investors yesterday as job openings hit their highest levels since 2007. The Wall Street captured media was gushing over the news. Naturally, the spin in these stories was that this was unequivocally good news, signaling an improving labor market. But is it really good news? I don't think so. I think it's a manifestation of an overheated bubble economy. The actual, not seasonally adjusted data looked like this. The year-to-year growth rate was a smashing 17%. The highest since November 2012, and a breakout from the recent growth range. What could be wrong with that? The answer is clear on this chart. The last time there were this many job openings was at the top of the housing credit bubble in 2006 and 2007. At that time, the end was nigh. This data suggests that the current central bank-driven financial engineering credit bubble is also blowing its top. Instead of real estate agents and construction workers, this bubble is generating jobs for rocket scientists turned financial alchemists, and for the legions of people who clip their hair, finger, and toenails and their arborvitae hedges. This data is for April. We have to wonder where this line is now, as it follows the stock market blow-off into the stratosphere. The end of this asset crack-up boom is probably not too far off. As always, timing is the issue. Tick-tock. This Wall Street Examiner Fast Facts has been brought to you by the Wall Street Examiner Professional Edition, focused on the analysis of macro liquidity and market cycles for professional investors, traders, and sophisticated individual investors. Try it risk-free for 30 days at wallstreetexaminer.com. Get the facts. wallstreetexaminer.com.